Welcome to our deep dive on modern portfolio theory, or MPT for short, and the capital asset pricing model, better known as CAPM.
Yeah, those are really big ones.
These are, they're kind of key concepts, right, in
hmm
finance?
Absolutely essential, I would say.
Yeah, think of them as essential tools for anyone who wants to understand how risk and return work, in the market.
Yeah, like the fundamentals when you're
Yeah.
building a portfolio
Yeah.
and trying to balance that risk and reward.
Yeah.
MPT and CAPM are kind of the framework for how to think about it.
Okay, so let's dive in.
Okay.
Um, I'm seeing a lot of assumptions underpinning KPM,
Yeah.
like things like no transaction costs,
Yeah,
no taxes, and investors who act perfectly rationally.
right.
It feels a bit like a simplified world, doesn't it?
Well, it is a model.
Yeah.
And so any model that you build of the market, you have to make some simplifying assumptions.
Right.
Obviously, those aren't perfectly reflected in reality, but they help you to isolate the relationship between risk and return.
Mm.
And, that's how you analyze it.
So it's kind of like creating a controlled experiment in a lab where you're isolating certain variables to
Yeah.
see how they interact.
Yeah, exactly.
Okay.
And one of the key variables in TAPM is beta,
Okay.
and that measures what we call systematic risk.
Okay.
And that basically tells us how much an asset's price tends to move in relation to the overall market.
So a high beta means the asset is more volatile,
Yeah,
like a speedboat on choppy water,
sure.
while a low beta is more stable, like a cruise ship on a calm sea.
Yeah, that's a great analogy.
Okay.
So beta greater than 1 means the asset tends to amplify market movements.
Okay.
Beta less than 1 means it tends to move less dramatically than the market.
Interesting. And a beta of 0 would mean the asset's price doesn't react to market movements at all.
Yeah, that's exactly right.
Wow.
And then you even have negative betas, which are pretty rare,
Uh-huh.
but that would mean it tends to move in the opposite direction.
Wow. Okay, so how do we actually calculate beta?
So there's two main ways.
Okay.
One formula uses what we call the covariance
Okay.
of the asset's return with the market return, and you divide that by the variance of the market return.
Okay.
That's kind of a statistical measure of how much those returns tend to move together.
Okay.
And then the other way to calculate it
Okay.
is using what we call the correlation coefficient between the asset and the market, and you multiply that by the ratio of their standard deviations.
Okay.
And so basically what that is doing is it's capturing the strength and direction of the relationship between those two sets of returns.
So we're looking at how closely the asset's price movements track the market movements.
Exactly.
And this beta then feeds into the CAPM formula,
Right.
which I see is expected return of an asset equals the risk-free rate plus beta of the asset times the market risk premium.
Yeah, that's the big one.
Can we break that down?
Sure, so let's start with the risk-free rate.
Okay.
That is the return you would expect from an investment that is considered virtually risk-free, like a short-term government bond.
Okay.
That's like your baseline return that you can expect without taking on any significant risk.
So it's kind of the starting point for calculating the expected return.
Right.
Okay. What about the market risk premium?
So the market risk premium is the extra return that investors demand for taking on the risk of investing in the overall market, as opposed to just sticking with risk-free assets.
Got it.
So it represents the compensation that investors expect for bearing the uncertainty of the market.
Okay. So we're adding a premium to the risk-free rate to account for the riskiness of the investment.
Exactly.
And then the beta is telling us how much of that market risk premium to
Yeah.
add.
Higher beta, more sensitive the asset is to market movements.
Okay.
Higher the risk premium investors will demand.
So the CAPM formula is basically saying that the expected return of an asset is determined by the risk-free rate, the market risk premium, and the asset's sensitivity to market risk,
That's right.
which is beta.
Yeah.
Okay, now the derivation of the CAPM itself involves some complex mathematics.
Yeah.
But the core idea, I think, is that investors are only rewarded for bearing systematic risk,
Yes.
which is the type of risk that can't be diversified away.
That's right.
So it's not just about taking on any kind of risk.
Yeah.
It's specifically the risk
The risk inherent to the market as a whole.
inherent to the market as a whole.
Yeah. And the CAPM argues that unsystematic risk,
Okay.
which is the risk specific to individual companies or industries,
Yeah.
can be diversified away
Right.
by holding a well-diversified portfolio.
Okay.
So investors shouldn't be compensated for taking on that type of risk.
That makes sense. If I can reduce risk by diversifying,
Yeah,
I shouldn't expect a higher return for
Sure.
holding on to that diversifiable risk.
that's right.
Okay, now let's shift gears a bit
Sure.
and talk about the capital market line, or
Uh-huh.
CML.
Okay.
Um, I'm seeing a graph here. Is this a visual representation of the CAPM?
It's related, but it's a different concept.
Uh,
The CML is a graphical representation of the relationship between expected return and risk
Okay.
for efficient portfolios.
Okay.
And those are portfolios that offer the highest expected return for a given level of risk.
Okay, so it's like a map showing us the optimal trade-off between risk and return.
Precisely.
Okay.
It shows us the best possible combinations of risk and return that we
Headline?
can achieve
Okay.
by investing in a portfolio that includes both risky assets like stocks
Yeah.
and a risk-free asset like a government bond.
So it's not just about picking individual stocks, but about finding the right mix of risky and risk-free assets to create a portfolio that meets our specific risk tolerance and return goals.
Exactly. And the CML provides a visual guide for understanding those optimal combinations.
Okay.
Yeah.
Got it.
Yeah.
So the CML is kind of like a frontier showing us the best we can do in terms of balancing risk and return.
That's a great way to put it.
Okay.
And the slope of the CML tells us how much additional return we can expect for taking on additional risk.
So a steeper slope means we get more bang for our buck in terms of risk and return.
That's right. A steeper CML means that the market is rewarding risk-taking more generously.
Got it. But the CML doesn't tell us how to build a portfolio, does it? It just shows us the possibilities.
Yeah, that's where modern portfolio theory comes in.
Okay.
MPT is all about finding the optimal mix of assets
Oh.
to create an efficient portfolio that aligns with an investor's risk tolerance and return goals.
So if the CML is the map, MPT is the navigation system
Yes.
that helps us chart our course.
Exactly. It provides the tools and techniques
Okay.
for constructing those portfolios that maximize expected return for a given level of risk
Okay.
or minimize risk for a given level of expected return.
Makes sense.
Yeah.
Okay, now I'm seeing a whole bunch of performance measures here.
Okay.
Trainer measure, Sharpe
Yeah.
measure, Jensen measure,
Right.
and more are these different ways of evaluating how well a portfolio is doing.
Yeah, they all give you different perspectives on how to evaluate performance. And it's important because, while returns are important,
Yeah.
they don't tell the whole story.
Right.
You also need to consider the risk that was taken to achieve those returns.
Right.
And so that's where these performance measures come in.
Okay.
They allow us to compare portfolios on a risk-adjusted basis
Got it.
and get a clearer picture of which portfolios are truly delivering superior performance.
So it's not just about how fast a car can go,
Right.
but also about its handling fuel efficiency and safety features.
Yeah, exactly.
Okay.
So let's start with the trainer measure.
Okay.
The trainer measure focuses on systematic risk,
Okay.
measured by beta,
Okay.
and it tells us how much return a portfolio generated for each unit of market risk taken.
Okay, so a higher trainer ratio is better
Yes.
because it means the portfolio is delivering good returns without taking on an excessive amount of market risk.
Yeah, think of it like two mountain climbers.
Okay.
One climber reaches the summit faster but takes a more dangerous route. The other climber takes a bit longer
Uh-huh.
but chooses a safer path.
Right, so even though that first climber got there quicker,
Right.
maybe the second climber is considered to be more efficient or more skillful
Right.
because they achieved the same goal with less risk.
Exactly.
Got it.
So the trainer measure is all about evaluating performance relative to that systematic risk taken.
Okay, got it. Now, what about the Sharpe measure?
Yeah.
How does that differ from the trainer measure?
So the Sharpe measure also looks at risk-adjusted returns.
Okay.
But instead of just focusing on systematic risk,
Okay.
it considers the total risk of the portfolio,
Okay.
measured by its standard deviation.
So it takes a broader view of risk.
Yes,
It encompasses both the market risk and then the specific risks
that's right.
of the assets within the portfolio.
Precisely.
Okay.
So the Sharpe ratio tells us how much extra return we're getting for each unit of total risk.
Okay.
A higher Sharpe ratio generally indicates a better risk-adjusted performance.
Okay, so we've got trainer focusing on systematic risk, Sharpe focusing on total risk.
Yes.
What about the Jensen measure? Where does that fit into this puzzle?
Okay, so Jensen's alpha, as it's often called,
Okay.
measures a portfolio's performance relative to its expected return based on the CAPM.
Okay.
So it essentially tells us how much a portfolio outperformed or underperformed the market given its level of risk.
So it's a measure of how much value a portfolio manager is adding above and beyond what we'd expect based on the market risk taken.
Exactly.
Okay.
Positive alpha suggests the manager is skillful in selecting stocks or timing the market.
Okay.
Negative alpha indicates underperformance relative to the market.
Okay, so it's like giving the portfolio manager a grade based on how well they did
Yes.
compared to what we'd expect from just a passive investment in the market.
That's a great analogy.
Okay,
Yeah, so Jensen's alpha is a very useful tool for evaluating active management.
got it. So we've got these three core measures,
Yes.
Trainer, Sharp, and Jensen.
Right.
Each one gives us a different perspective on risk-adjusted performance.
Right.
Are there any other performance measures that we should be aware of?
Yeah, there's a couple others that can provide valuable insights
Okay.
depending on the situation. So, for example, you have the information ratio,
Okay.
which measures the risk-adjusted return of a portfolio relative to a benchmark.
Okay.
So it's similar to the Sharpe ratio in a way,
Okay.
but it's specifically focused on active management.
So it's telling us how much extra return the manager is generating.
Okay. For the risk that they're taking relative to the benchmark.
Got it.
So a higher information ratio generally indicates better performance in terms of that active management.
Okay, that makes sense. What about tracking error? I'm seeing that term pop up here.
So tracking error measures how closely a portfolio's returns track those of its benchmark.
Okay.
It's essentially the standard deviation of the difference between the portfolio's returns and the benchmark's returns.
So a low tracking error means the portfolio is hugging the benchmark pretty closely.
Exactly, like a race car driver staying tight on the racing line. So low tracking error is generally desirable for passive investment strategies
Right.
that aim to replicate a specific index.
Got it. What about the Sortino ratio? How does that one work?
So the Sortino ratio is similar to the Sharpe ratio,
Okay.
but instead of considering all volatility,
Okay.
it focuses specifically on downside volatility,
Yeah.
the risk of negative returns.
So it's like a Sharpe ratio that's specifically tuned to measure the risk of losing money.
Exactly.
Got it.
Because it's useful for investors who are particularly concerned about avoiding losses.
Okay, so we've got a whole toolbox of performance measures here. How do we know which one to use
That's a great question.
in a given situation?
It really depends on the specific investment context and the investor's goals.
Okay.
So, for example, if you're comparing two portfolios that represent an individual's entire wealth,
Mm-hmm.
the Sharpe ratio, which considers total risk, might be the most appropriate.
Okay.
But if you're evaluating a portfolio that's just part of a larger, well-diversified portfolio,
Yeah.
then the Trainer ratio or Jensen's alpha, which focus on systematic risk, might be more suitable.
Got it. So it really depends
It
and
depends.
on the context.
Yeah.
Okay.
And there's a nice table in one of our sources that kind of summarizes all this.
Perfect. Yeah, this table is really helpful. It clearly lays out the different types of risk that each measure addresses and when each measure is most useful. But before we get too lost in the details, I want to kind of take a step back and look at the big picture.
Mm-hmm.
Like, what are the key takeaways from our deep dive into MPT and CAPM?
You know, I think what's so fascinating about these concepts is that they really connect these seemingly abstract ideas to real-world investment decisions. You know, they really emphasize that risk and return are inherently linked, and understanding this relationship is crucial for building a successful portfolio.
So it's not just about chasing the highest returns. It's about finding that sweet spot, where we're comfortable with the level of risk we're taking to achieve our return goals.
Exactly. MPT gives us the framework for building that balanced portfolio, while CAPM helps us understand how each asset contributes to the overall risk and return profile. And then we have these performance measures, which are like different lenses through which we can evaluate how effectively a portfolio is navigating that risk-return landscape.
Okay, so armed with this knowledge, what's the one piece of advice you'd give to our listeners as they embark on their own investment journeys?
You know, this is where it gets really interesting. Don't let the complexity of these models intimidate you. The real value of MPT and CAPM lies in the intuition they provide. They remind us that diversification is key to managing risk, that higher returns usually come with higher risk, and that there's no magic formula for beating the market consistently.
It's about understanding the core principles, not about memorizing formulas or becoming a quant. It's about being an informed investor who makes decisions based on sound principles rather than emotions or hearsay.
Exactly. And remember, these models are just tools. They can provide valuable insights, but they can't predict the future with certainty. The market is constantly evolving, and there will always be surprises.
Right, it's about having a framework for making decisions, not a set of rigid rules to follow blindly, and that's where continuous learning becomes crucial. We need to stay informed about market developments and adjust our strategies as needed.
Absolutely. The financial world is a dynamic. Embrace that challenge, stay curious, and never stop learning. The more you understand about investing, the better equipped you'll be to navigate the complexities of the market and achieve your financial goals.
Well said. That's a great note to end on. We've covered a lot of ground in this deep dive exploring modern portfolio theory, the capital asset pricing model, and the various performance measures that help us evaluate investment success. But this is just the beginning of your journey. We encourage you to explore these concepts, further dive into the resources mentioned in the show notes, and apply these insights to your own investment strategy.
And remember, the most valuable investment you can make is in your own financial education. The more you learn, the more confident and informed you'll become as an investor.
That's fantastic advice. And on that note, we'll wrap up this deep dive. We hope you found it insightful and engaging. Until next time, happy investing.